Now we have a couple of housekeeping items that we want to take care of before we get started. Again, I'm Christina Mason, Vice President of Government Affairs here at WISPA. Thank you for joining us. Number one, the stuff that we're going over today is off the record. It's on background. So of course, if there's anything you want to take away, just realize that it's not on the record. Second of all, friendly reminder to renew your WISPA membership if you haven't yet. And third, we want to welcome Jeff Carlisle. He's a dear colleague of a good friend to WISPA, Steve Coran with the Lerman Center. I'll give him an opportunity to give a few background points. But if you have any specific questions, feel free to reach out. Either A, there is a question box on the side of your screen. We will try to get to as many questions as we can. This is a widely attended webinar, so unfortunately we may not be able to get to everyone's questions. Feel free, any questions you have after this, to reach out to myself at cmason@wispa.org. And I'm sure Jeff has, well, he has his contact information up on the screen now. So we'll try our best to get to your questions, but obviously we have to manage how many we can do. With that, I think we have enough time, we gave enough time for folks to join. I'll turn it over to Jeff and we will get to this now.
Hi, this is Jeff Carlisle. I'm of counsel at Lerman Center, and just a couple of background points for me. I've been largely practiced in telecommunications law for the last 25 years, including service as a bureau chief at the FCC. I have done an extensive amount of work in both in wireless, satellite, wireline issues, universal service and whatnot. I have also had something of a sideline in doing some tax-related issues, largely around nonprofits and some business tax. And that has given me something of a view into this 700-page behemoth bill that was signed into law last Friday. So the purpose of today's discussion is to really cover the waterfront of the business-related provisions of this law, because it's not just the SBA loans that a lot of people have heard about. It's also things like significant changes to the tax code, significant changes to the Family and Medical Leave Act. And so the idea is to give you this resource, this presentation, that's basically the punch list of the things that you should be aware of over the next year as these various business-related provisions play out and are implemented by SBA, Treasury, the Department of Labor, the IRS, and so on. So let's get started. As I'm an attorney, we're going to lead off with a brief set of disclaimers. This is not intended to create an attorney-client relationship. It is purely educational. It does not constitute legal advice. This is very complicated stuff in some respects, so you are strongly encouraged to consult with your attorneys, tax advisors, financial advisors, as you have specific questions, and you will need to do that over the next year as you discuss how specifically to handle some of these changes with your treatment of taxes and how you spend your investment dollars over the next year. And of course, any reliance on the information in the presentation is taken at your own risk, and that's why we advise folks to consult with their own attorneys and advisors. All that being said, what we're going to cover today are 6 major areas. They're the SBA loan programs, they're the Treasury loan programs, which are a totally separate set of $454 billion of loans, and an additional $46 billion, which are targeted to specific companies. They're telecom-related grant programs. We won't be going into a lot of detail about those, but we're mentioning them so you are aware of them. And as they're implemented by RUS and the FCC, you'll know what they're talking about, or at least have some basic familiarity. There are significant changes to the tax code that will change handling of certain elements of your taxes both this year and in prior years. So please, so we're covering all of those. We're also covering Family Medical Leave Act changes that may modify some of the changes that were made by earlier emergency coronavirus legislation. And then we're going to cover briefly a few additional items that any employer or company should be aware of as we're moving along, which are changes to how 401ks handle early withdrawal for coronavirus-related reasons, changes to pension plan funding obligations, and expansion of unemployment insurance. So you understand what some employees and independent contractors may be looking at as their different options. Moving along. So we'll start with the SBA Payroll Protection Program. This is part of the SBA's larger, what's known as the Section 7A program, and many of you on the call may have already received loans under the 7A program. But this vastly expands it. There will now be $349 billion for loans to businesses with 500 employees or less, or that otherwise meet SBA's small business size standard. And I haven't seen a lot of discussion about this, so I think it's important to mention. The SBA has a set of North American industry codes that it has, that's on its website, that it has designated different small business size standards for. So certain industries may be allowed to have more than 500 employees, and specifically wireline and wireless telecommunications carriers and telecommunications resellers can have up to 1,500 employees and still be considered a small business and thus eligible for a payroll protection program loan. Loans will not be provided directly by SBA. Rather, they'll be provided by SBA approved lenders. I would strongly advise you, if you have not done so already, to go to the SBA website, find the SBA district office that is closest to you, and see what web-based resources they have available. Many of these district offices have lists of approved SBA lenders in their areas, and in some cases, how the volume of loans that they handle. But this is all readily available through a Google search for SBA lenders, district office, that sort of thing. The CARES Act specifies that a payroll protection program can have an interest rate of no more than 4%, and payments of principal and interest will be deferred for at least 6 months, could be more, could be 12 months. But they're certainly starting from a baseline of 6 months on the deferral. Very important, the credit elsewhere requirement is being waived. That is typically for a Section 7A program, you have to show that you can't reasonably get comparable credit anywhere else, and the CARES Act does away with that. So you do not have to show that you can obtain credit from another source in order to qualify for Section 7A PPP loan. What's the maximum amount you can get? Well, that's 2.5 times your average monthly payroll cost, or $10 million, whichever is less. And importantly, and this is something that a lot of people are getting wrong because a lot of summaries have been put out there that are getting it wrong. Employee compensation for purposes of determining whether you, determining how much you can get from a PPA loan, and also the allowable costs that you can spend that loan money on, are capped at a pro rata at $100,000 annual compensation, prorated. Okay, so that means that if you're calculating your 2.5 times average monthly payroll cost, you're going to take any employee that makes more than $100,000 and just count for that 2.5 months, no more than $100,000 prorated for 2.5 months. So it is a cap, it is not an exclusion. And I'm just going to emphasize that one more time because this is a very pernicious misunderstanding. You do not exclude employees who make more than $100,000. You just cap them at $100,000, and you can use loan proceeds to pay up to that prorated $100,000 amount. So what else can you use it for? You can use it for payroll costs, again, up to $100,000 annual salary prorated per employee, including any salaries, wages, or commissions, cash tips or the equivalent are included in that, any payments for vacation or other types of leave, allowances for dismissal or separation, payments for group healthcare benefits, retirement benefits, state and local taxes on compensation. But importantly, it does not include compensation for any employee with a principal place of residence outside the US. I don't know how many folks on the line may have that issue, but it is an important exclusion that you should know about. But outside of payroll costs, you can use the PPP loan for several other types of costs. It does not only have to be used for payroll costs, or even primarily. It can be used to pay group healthcare benefits. It can be used to pay mortgage interest. It can be used to pay rent or utilities, or it can also be used to pay interest on debt incurred before February 15th, 2020. So all of those things you can use the loan to pay for. One other thing that a lot of summaries are getting incorrect are the forgiveness provisions of this. And so this is probably a little more detail than you bargained for, but we will get through it quickly. But I do want to provide you with the real information on how the loan forgiveness works. And remember, this is different from deferral. Payments on principal and interest will be deferred for the first 6 months, but you will have to start making them. This is total forgiveness. So this is the SBA coming in and paying off part of your loan. And how this works is that you will have to apply for it as a borrower, but then your lender will forgive a portion of the indebtedness in an amount equal to any amounts you spend in the first 8 weeks on payroll costs, again with the $100,000 prorated cap, interest on mortgages entered into before February 15th, 2020, rent on leasing agreements with the same date restriction, and utility payments for service that began before February 15th, 2020. So that includes electricity, gas, water, transportation, telephone, and internet access. So so whatever you spend for the first 8 weeks of the loan, you consolidate on these 4 things. You can consolidate that together and apply to your borrower with substantiation of those amounts for loan forgiveness in that amount. The loan forgiveness cannot exceed the principal amount. So that's an important limitation here, but basically this is a significant aspect of this program and essentially turns some of these loans at least partially into grants. Forgiveness will be reduced in one of 2 situations. If you either reduced your employees or you reduced your wages more than 25% to any employee making $100,000 or less, okay? We'll get into how that might change depending on when you did it, but let's explain how this is calculated. The way you calculate what your reduction is if you reduced your employees is you take your average monthly full-time employees during the first 8 weeks, and then you divide either by the average monthly full-time employees from February of 2019 through June 2019, or at your option, you can also choose average monthly full-time employees from January 2020 to February 2020. Note, seasonal employers must use the first methodology, okay? So you divide your monthly full-time employees for the first 8 weeks by one of these 2 options, and then you get a quotient, and you multiply your total amount of forgiveness by that amount. So, for quick example, let's say you got a $10,000, you had $10,000 worth of eligible expenses for the first 8 weeks. You have 8 employees today. Your best situation was you had 10 employees a year ago. So you divide 8 by 10, you get 0.8, you multiply that by 10,000, your total loan forgiveness can be no more than $8,000. If you reduced wages, it's somewhat simpler. The reduction is just equal to the amount of any salary reduction for each employee that's greater than 25%. So if you did an across the board for 10 employees and they were all making, let's say they were all making $50,000 a year, 10 employees, you reduce them by half, so that's 25,000 times 10, 250. Well, okay, I didn't actually prepare that, so sorry about that. The numbers are getting ahead of me, but you get the idea. So any reduction greater than 25% across the board, you have to take off your total forgiveness. However, if you reduce wages or employees between February 15th, 2020 and April 26th, 2020, so that's from February 15th through a month after the enactment of the CARES Act, and that reduction of either is eliminated by June 20, 2020, there's no reduction in forgiveness, okay? So that is an important aspect of this. It's actually June 30. That's a typo in the presentation, but it's June 30, 2020. There is no reduction in forgiveness. So that's how it works, and it's a little bit complicated. Again, maybe a little bit more detailed than is warranted given the otherwise high level that we're trying to keep this at. But I wanted to make sure we had an opportunity to talk through this and you had the opportunity to see this on a slide so you fully understand it. Because again, a lot of summaries I'm seeing from small business associations and whatnot are getting this wrong. So now we're going to leave the world of the PPP loans and go to a different type of SBA loan, which are economic injury disaster loans, which is an existing program. It provides loans to small businesses defined as above, so 500 or less, but for certain telecommunications companies up to 1,500. And it can provide loans of up to $2 million. It's provided directly by the SBA. You can go directly to their website and apply for one. You can do it today, and I've heard people have already been doing it. The PPP program has not yet been set up. People are looking next week, beginning Monday of next week, for the SBA to have more resources to show that this loan program is getting started. It's not up yet. EIDL loans, on the other hand, can be provided today. There's an accelerated application process that can also provide a $10,000 advance within 3 days of the application. I'm not entirely sure if you can get that today or that may have to wait on implementation, but certainly EIDL is already up. This can be used, that $10,000 advance, by the way, can be used to provide paid sick leave to employees, maintain payroll, meet increased costs for materials, and that's all the sorts of things that you have to deal with during a disaster. Importantly, under the CARES Act, the $10,000 advance does not need to be repaid if you're subsequently denied an economic injury disaster loan. These loans, by the way, will not have the same kind of interest rate that the PPP loans do. It'll be a higher interest rate. It does not have the same kind of forgiveness provisions that are specifically written in for the PPP loans, but it is a resource that's out there if you need it. On loan subsidies, there are specific types of loans that SBA makes that the CARES Act separately provides a subsidy, that the SBA itself will pay for 6 months of principal, interest, and associated fees for other types of Section 7A loans, for any Section 7A loan that you may have that's not a PPP loan. So there are standard 7As, express 7As. Again, the SBA website has a whole list of different types of 7A loans, and you may very well already have one, so good to check on that. Section 5 and Section 504 economic development loans, which are loans made to, you guessed it, fund economic development in areas, and microloans. So if you have any of these loans, you may want to check with your SBA district office and just make sure that they are planning to implement this. It appears that this will just be automatically applied by SBA and lenders, but it's always good to double check this to make sure that that in fact is the plan. Leaving loan programs and forgiveness, there was a change to the bankruptcy code, which benefits small businesses. So in the unfortunate event, if you were to have to file bankruptcy in the next year, the small businesses do qualify for streamlined and flexible bankruptcy procedures under Chapter 11. So if a bankruptcy is commenced within the next year, the eligibility for that flexible treatment will increase from about $2.7 million in debt, which is the normal threshold, to $7.5 million of debt. So it provides a measure of additional flexibility and speed in terms of resolving bankruptcy. Okay, so that was the Small Business Administration Loan Program and the programs administered basically for small businesses. You should also be aware of a series of provisions that give the United States Treasury the ability to make $500 billion in loans to various different types of entities. Now, what's been focused on in this program have been mid-sized business loans, which are business loans for entities from 500 to 10,000 employees. Now, you may not qualify under that. You may not be large enough to qualify under that, but you may still be able to qualify for direct loans from Treasury, which may be an option for you if for some reason you have not been able to obtain an SBA loan, or you are some other kind of entity where there's an eligibility issue. Bottom line, you should understand that there are three kinds. The first kind is $46 billion for direct Treasury loans to passenger and cargo air carriers and businesses critical to maintaining national security. What does that mean? It was not defined in the Act. So presumably Treasury implementing regulations will define this. And it is generally expected to be defense related industries. I have not heard that it could be infrastructure industries, but we'll have to take a look at the implementing regs and see if any provision is made for industries that touch telecom. The balance of the program, $454 billion, are loans and loan guarantees under what's known as Section 13.3 of the Federal Reserve Act. You may recall that this was, or may not, that this was generally used to provide huge lines of credit during the 2008 financial crisis. Typically and historically, it has only been offered to financial entities. However, in this case, it is being used to allow two types of loans administered by Treasury. One, a program of direct loans from Treasury, and two, a program of lender loans financed by Treasury for mid-sized businesses. On direct loans from Treasury, this is the one that small businesses may be interested in as an alternative. Treasury can make direct loans to businesses of any size. It has a few more explicit restrictions than the SBA loans have. It has to be created or organized in the US and have significant operations and a majority of employees in the US. The terms are completely up to Treasury implementing regulations, but it's unlikely that they'll have as favorable an interest rate as the SBA loans, because the Act specifies that they will be at market rates and the duration may not be longer than 5 years. And there are more, as I mentioned, there are more restrictions on borrowers. So if you apply for this, you have to certify that you won't make any stock buybacks, dividends, or capital distributions for the term of the loan plus 1 year. There are also compensation restrictions. Any employee with above $425,000 in 2019 can't receive more, and those employees are limited to 2 times that amount in severance. Employees with compensation over $3 million in 2019 can't make more than $3 million plus half of the amount over $3 million, again, for the term of the loan plus 1 year. So may or may not be relevant, but something to keep in mind should you think this is an alternative for you. On the mid-sized business loans, these are the loans for businesses between 500 and 10,000 employees. These have a better interest rate of no more than 2%, and no principal or interest payments for at least the first 6 months, could be longer at the discretion of the Secretary of the Treasury. They have to make even more certifications than the direct Treasury loans. I'll just call out a few of these that are the most important. They have to use the funds to retain at least 90% of their workforce until September 30, 2020. They have to intend to restore, if they've laid people off, they have to intend to restore 90% of its workforce as of February 1st, 2020, and restore all reduced compensation and benefits no later than 4 months after the end of the federal public health emergency. So when that's declared 4 months later, they've got to be back. The workforce has to be back at 90%. Again, has to be in the US, can't be a debtor in a bankruptcy proceeding. It's got the same restrictions on dividends, stock buybacks, and so on. Additionally, you must commit to not outsource or offshore jobs for the term of the loan and 2 years after. You can't abrogate existing collective bargaining agreements for the term of the loan and 2 years after. And you have to remain neutral in any union organizing effort. Now, one thing that I've seen some back and forth on, and I'll call it out in case it is relevant, the compensation limits, that 425,000 and 3 million limit that I mentioned, these do not explicitly apply to the mid-sized business loans if you look at the wording of the CARES Act. But it's possible that this was a confusion in the document. It's very complicated. So we'll see if that is confirmed in the implementing regs. It may very well be that they'll end up applying those compensation limits as well. So moving along, and I know only some of that may be relevant to smaller providers, but again, important to know about so you have the full context of everything that's going on in the program. And if you hear something about a loan program that doesn't necessarily apply to you, you will at least know offhand so you don't waste a lot of time pursuing it. Telecom related grant programs in the CARES Act. There was money made available directly to the telecom sector, $200 million for what is now the FCC COVID-19 telehealth program. And this will support this will provide funds to healthcare providers to purchase telecommunications, broadband connectivity, and devices for providing telehealth services. This is an outgrowth of the existing telemedicine program, but it obviously has this specific appropriation for it. There are $100 million for additional grants under the Rural Utility Services existing broadband deployment pilot program. The one restriction on this is that it must be used for areas where 90% or more do not have access to 10 megabits per second download, 1 megabit per second upload. And then there's $25 million for RUS, distance learning, telemedicine, and broadband. Again, an additional appropriation for their existing program. Additionally, and it's worth noting that it allows the Veterans Administration to enter into short-term telecom contracts to provide services to isolated veterans to support mental health services. So if you're on the line and you provide services to particularly remote areas, you should be aware of this, and you may very well be contacted by the local VA, or if you know about a local need, you may want to reach out yourself. I would also mention that there's been a lot of talk about a possible fourth stimulus bill, which would include more direct appropriations for telecommunications infrastructure. We'll have to see how that develops over time and how it's allocated, but this was just a small part of that going forward. So now we're going to move on to tax code changes, and we're going to move through these fairly quickly, not because they're not interesting to the extent taxes can be interesting, but because because there's a series of these. Not all of these will be applicable. I want you to be aware of them, but we're not going to spend a great deal of time on it. Of course, if you have a question, please feel free to ask. We'll start with the employment tax credit, which most of you will probably see. Again, there are aspects of this that various summaries get wrong. Qualified employers will receive a credit against employment taxes of 50% of qualified wages for the period from March 13th through the rest of the year. You can qualify under either of two situations. You've either had to fully or partially suspend your business due to government orders, or you suffered a decline in gross receipts over a period of 50%, and that begins in the quarter when your receipts were less than 50% compared to the same quarter in the prior year, and then lasting until the quarter when gross receipts exceed 80%. Of course, if they don't, you go through to the end of the year. Qualified wages are limited to $10,000 for each employee. And for employers with 100 employees or less, there's more relief. Any wages you paid during the period of shutdown or decline up to the $10,000 qualify for the 50% credit. If you're over 100 employees, only the wages that you paid for employees not providing services because of the shutdown or decline will apply. Now that there may be no real practical difference between the two of those things, but it is a difference that was written into the CARES Act, so it is something to be aware of. Also, there will be a delay of employer payroll taxes, the 6.2% Social Security tax. That is deferred through the end of the year. 50% is going to be payable January 1st, 2021. The other 50% payable on January 1st, 2022. Note that if you get a PPP loan under the CARES Act and you get forgiveness under it, you don't get the delay. You have to meet your normal payroll tax dates. So that is an important part of this that is getting missed in some cases that folks should be aware of. Also, in 2017, the Tax Cuts and Jobs Act eliminated the ability of businesses to carry back net operating losses to prior tax years. The CARES Act reverses this, and it now allows carrybacks of net operating losses for 2018, 2019, and 2020, allowing you to carry back these losses to 5 prior taxable years. Importance there, of course, is you can file an amended tax return and get a refund, which is intended to increase liquidity for businesses who otherwise would have qualified for the deduction. Importantly, the Tax Cuts and Jobs Act also limited the use of net operating losses to offset no more than 80% of taxable income. And now the CARES Act changes that for any taxable year before 2020. It makes clear it allows a 100% offset. So that is definitely something worth talking about with your tax advisor if you believe you've got an eligible net operating loss. The corporate alternative minimum tax, corporate AMT, the TCJA repealed that in 2017, but allowed refund of credits that folks had earned through 2021. So if you've got an AMT credit, you should now know that you can accelerate the credit by claiming the entire amount for the entire amount of credit that you're due through 2021 for either your 2018 or for both your 2018 and 2019 tax years. And Treasury is required to provide you a refund within 90 days of a valid claim. Very quickly, the deductible interest expense was raised from 30% to 50% for both tax year 2019 and 2020. Limits on deductions for corporate charitable donations were raised to 25% of taxable income for any donations in 2020 And the same thing, there was a raise for food inventory donations from 15 to 25%, again for donations made in 2020. So as you're doing your tax planning, please consider those increases. One other thing that may be applicable to a lot of different taxpayers is an oversight from the TCJA, which should have made qualified improvement property eligible for bonus depreciation, meaning you can depreciate any improvement cost in the year you incur it, rather than spreading it out over the entire depreciable life of the property. It intended to do that by changing the depreciable life to 15 years, but by mistake did not do this. The reason a lot of folks might qualify for this is qualified improvement property means really any improvement made to the interior portion of a non-residential business building anytime after the building was placed in service. So the change now is retroactive to January 1st, 2018. So you can write off, so if you had significant improvement costs that would qualify as as qualified improvement property, you may want to talk to your tax advisor and see if you can claim a refund on the basis of writing off that entire cost in 1 year. It also allows employers to contribute $5,250 against student employee loans and then count that as tax-free compensation. Several Family Medical Leave Act changes have been made that you should be aware of. Earlier emergency legislation had expanded the eligibility for certain types of paid leave, emergency paid sick leave, and so on. And the CARES Act actually places limits on that. So to clarify the relief that was provided earlier. So for paid leave, you're not required to pay more than $200 per day or $10,000 in the aggregate. For emergency paid sick leave, you're not required to pay more than $511 per day or $5,110 in the aggregate. And then if somebody is taking leave because they need to care for a quarantined individual or child, it's limited to $200 per day or $2,000. Obviously, you can pay more if you want, but the Act will not require more. And then it expands the eligibility for specific types of Family Medical Leave Act leave and paid sick leave provided for COVID-19 purposes for people who were laid off and then rehired. So it just basically makes it easier for those folks to qualify for that kind of leave. Importantly, it also accelerates tax credits to employers for paying for leave under the FMLA by providing an advanced tax credit rather than having to wait to the end of the tax year. We're almost done. The things you should be aware of is that the CARES Act allows individuals to avoid the 10% penalty for early withdrawal from defined contribution plans like 401ks of up to $100,000 for coronavirus-related purposes after January 1st. So if somebody withdraws, so that may result in withdrawals from 401k plans that will need to be honored. If you have a pension plan, you should, you have to make regular funding obligation payments. Those are deferred through 2020 until January 1st, 2021, but importantly, they are then due with interest. It also provides that your status for benefit restrictions, which basically applies to underfunded plans, your status as of 2019 will continue to apply through 2020. So you won't have a negative impact as a result of that. And also there's an extensive section of the CARES Act that deals with expanded unemployment insurance benefits, which you should be aware of. It's an additional amount of $600 per week in addition to the state-funded benefits. So whatever the state is paying now, it's $600 more on top of that. It also expands eligibility for people who are self-employed, independent contractors, and individuals with limited work history. And it provides 13 weeks of additional federal payments after the weeks that are required under the state plan run out. So that is it, and we can move on to take questions.
Thanks, Jeff. That was excellent. Before we move to questions, I just want to let everybody know these slides will be made available, as well as a recording of the webinar. We will make sure you have access to that and make sure you have that information. So you can review this wonderful presentation at your leisure. So going into questions, Jeff, there were a lot of questions around what counts as salary under the PP loan definition. So a couple questions included contractors. Would contractors, 1099 employees be considered salary? Would S Corp owners compensation be considered salary? Would contractors hired outside of the dates you provided, would their compensation be considered salary for these purposes? And I know you don't have the guidance, you know, they're still working on guidance. So to the best of your ability, let us know your thoughts on that.
Yeah, it's a good question. I believe from what I've seen in the SBA loan program, it is limited to actual employees. So as compared to independent contractors. So and one of the important things to understand is independent contractors and self-employed people are now eligible for these SBA loans as well as other types of relief like the unemployment compensation and so on. So that exclusion of contractors from the definition of employees it's been made up for in other parts of the Act. I would, however, caution you, if you have very specific questions, well, we've got a S Corp or something like that, definitely go to your own tax lawyer or financial advisor and ask their view on this as it goes forward. We will also learn a lot from the SBA and Treasury implementing regulations, which have just not been released yet. They'll be released in the next week to 2 weeks, hopefully.
Wonderful. Another, a few questions under PPP, so we'll begin there. In terms of utility, definitions of utility, obviously WISPs have some payments that they have to make, particularly regarding backhaul, but other upstream providers. Would those, in your estimation, be considered utility payments for purposes of this loan? And what kind of guidance do you have there?
Yeah, it's a good question. I think if you're talking about electricity for, say, servers or your headquarters or something like that, or where you're keeping the equipment, I think that would pretty clearly qualify as a utility payment. If you're talking about, lease of a backhaul facility, that would be a harder that'd be harder to fit into this program, but perhaps not impossible. The important thing to know about that is that utilities, for the purpose of covered amounts and what you can spend the money on, is not, it just says utility payments. It's not otherwise defined. The utility payments are defined under the section that defines loan forgiveness. So the amounts that you spend in the first 8 weeks on those specific items I listed on the slide that's up now, those are defined in the Act. It's not otherwise defined. So I think it's definitely worthwhile to see if there's further detail provided as to see, what exactly is meant by the utility payments. But I would say certainly stuff that is being used at your main offices and certainly, electricity for that kind of equipment is going to be included. It is going to be, I think, a much closer question as to whether, say, special access or backhaul facilities would be similarly included. That would seem to probably be, I would say, a very borderline case. And we would definitely need to see the implementing regs to know that.
Wonderful, thank you. I The next question kind of relates to PPP and the EIDL program. To clarify, can WISP apply for just one or the other? Does the size, the employee size, eliminate a WISP if you have fewer than 500 employees? Is there any possibility to go and access the Treasury loan or any other loans? Are you only limited to the program for under 500 employees?
Well, you wouldn't qualify for the mid-size Treasury loans. So you couldn't apply for those because that's intended for 500 to 10,000, but you could apply for direct Treasury loans because that is not limited to any specific size. It is basically whoever the Secretary of the Treasury defines in the implementing regs that they want to give the money to. So as of right now, that would be the alternative if you didn't want to go to SBA. Now, it's entirely possible you could apply for a direct Treasury loan and they could say to you, well, why didn't you go to SBA and ask that question? But that would, just on the face of the act, that would be that would be how that would work.
Okay, and there was another question regarding the forgiveness of PPP loans. Would any of this, in your estimation, create a taxable event? The forgiveness, et cetera?
You found the one thing I left out of the slides. Excellent question. The CARES Act specifically provides that any amount forgiven under the PPP program is not considered gross income. So it is excluded from it is not considered income to the recipient, to the borrower. So that's a very, very important point. Interestingly enough, there is not a similar provision with regard to any sort of amounts that might be forgiven in the Treasury program, though there are explicit provisions in there saying that there is no forgiveness under the Treasury loan program. So it may not have been a similar issue there. But for the PPP loan, yeah, when that is forgiven, you do not have a tax liability on that.
Wonderful. Another question, and maybe Jeff, just based on your longtime experience with the federal government, any sense of timing on how long it would take for SBA or any of these agencies to actually administer these loans? When could WISPs realistically expect to have money in hand? And using your best judgment may be the best answer here.
Well, I mean, everybody's best judgment is kind of, past performance is no guarantee of future results, especially when there's a pandemic going on, I guess. But there hasn't been a specific announcement, but there's been indications that SBA will try to get this up and running next week. And importantly, the CARES Act specifically states that the lenders are given discretion to make decisions on eligibility. So they're given essentially delegated authority to make a bunch of decisions without necessarily having to go back to SBA. So, and that is intended to accelerate the provision of this money into the marketplace. Another aspect of this that relates to this is the fact that the CARES Act doesn't provide any explicit type of prioritization for these loans. So I think one thing you should be aware of is the assumption on the part of a lot of people who are interested in these loans is it will be a first come, first serve kind of scrum to grab this money. Now, who knows what will actually happen and whether there'll be some steps that are introduced there to make it more of a reasonable process. But nobody's sure yet, and we haven't seen the implementing regs. So my advice to folks, bottom line on this, I think the money will come very quickly. I think, once it goes up, there will probably be theoretically, folks might be able to see money coming in within, by early May. early to mid-May. That's entirely possible given the speed with which this is intended to be rolled out. But I would advise you on that front, find out where your district SBA office is. Find out who your SBA lenders are in your area. That information should be at the SBA district office on their website. And if you already have an SBA lender, get in touch with your loan officer and make sure that, make sure both the SBA and as many lenders as you might be able to reach out to know you're interested, so that when this stuff drops, maybe without warning, but hopefully with some, when this stuff drops, you've done everything you possibly can to get yourself prepared for this, because it would really be a tragedy if you really needed the money but didn't get it because there were simple steps you could have taken that you didn't take in the next week or so.
Another good question kind of covers all or many of the aspects you discussed. Does a WISP have to show actual injury or demonstrate injury for any of these programs? Injury meaning loss of income or any COVID-related, pressures, or is this just available so that, for anyone, whether business is up or down?
There is no explicit requirement that you show, current losses at your business. You have to certify that, that the money is necessary in order to be able to continue continue operations and make payroll and things like that. But it's in terms of specifically showing, okay, I've got a current operating loss, I've got, I can't get funding anywhere else. All of those kind of requirements have been either reduced or eliminated for this loan program. So again, we'll see the specific requirements that SBA is going to put on lenders for a showing of needing a loan and being entitled to receive it. But I think for the time being, it is probably a better idea to assume that, if your business is under pressure, if you really do believe that you need this in order to in order to be able to keep everybody employed, then you should assume that you're qualified to get it until somebody tells you otherwise, and apply once you see the requirements.
And I think we have time for one more question, and it's probably a quick and easy one, or maybe not. Jeff, in your opinion, does this cover only full-time employees? And I'm assuming this is relating to PPP or the small business SBA related loans. Do those funds cover full-time employees, or are part-time employees included if they're employees and not contractors?
I believe they are. When we used FTEs for the calculation of the forgiveness, that's the language that the Act uses in order to have a metric for measuring that. But obviously, you can aggregate partial FTEs into full FTEs. So, I believe that that part-time employees are included.
All right, well, reminder to everybody else who submitted a question that either A, we may not have gotten to, or B, that are covered in the slides. Slides will be made available as well as the recording. We are very pleased to have you, Jeff. Thank you so much. This was very, very, very helpful. And again, reminder that if you have some questions, if they are more personally related to your legal or tax situation, we highly advise you to seek your counsel or your tax professional for those answers. Otherwise, Jeff and myself are available for general questions, programming questions, government affairs questions, etc. My email is cmason@wispa.org. I'm happy to get some questions to Jeff that may be remaining. And last, housekeeping item, we got some really good news while we were online today. The chairman, FCC chairman, just announced that he intends to make all 1,200 megahertz of this 6 gigahertz spectrum band available for unlicensed use. As folks know, WISPA has been heavily advocating for this, and thanks to the work of Steve Coran, who I believe is still on the line, and Jeff Carlisle, we, as a team, the WISPA team, has been able to get that good news. I don't know if Steve's on and wants to jump in with any 2-second overview, but I don't want to put him on the spot because I'm sure he's very busy working on these things to get good information out to you. So stay tuned, look to your email inboxes for more information on that. And with that, I think we're at the end of our time. Thanks again, Jeff, and we will be in touch with everyone shortly.